Hi, Wes Nichols here with Paramount Property Tax Appeal. Today's topic is all about inflation and how inflation impacts property taxes, and more importantly, what you can do from a property tax perspective to lower your property taxes to fight inflation and offset the negative impacts of inflation. So one of the things that we talk about with inflation when it comes to commercial real estate and even real estate in general is what we call negative leverage. So on income producing properties, market capitalization rates, let's say an apartment building in Southern California, we're in around the 4 to 4.5% cap rates. And this is a direct measurement of the inherent risk. So your cap rate is an association of risk. So the higher the risk, the higher the cap rate. However, in the last few years, since the COVID pandemic and the Fed lowering interest rates to basically zero, investors and people have enjoyed really low interest rates. And because of that, we've seen really low cap rate transactions. For example, multifamily went from 4 to down to 3 to 3.5%, a full point to half point basis points in reduction of cap rate. Now, typical market investors try to achieve 1 to 2% of a cap rate higher than their borrowing rate. So for example, if I could get a loan at a 3% on a 10-year mortgage, I would anticipate getting a capitalization rate around 4 or 5%. I want to get a capitalization rate that's higher than what my borrowing costs are. Whenever your capitalization rate is lower than your borrowing costs, that's called negative leverage. And that's what we're going to probably start seeing, but more importantly, what we want to avoid as investors. When borrowing costs rise, cap rates will increase, and thus property values will decrease. Some of the things that we're seeing in the headwinds that we want to bring to your attention and why you should consider doing a property tax appeal now or start planning for it for years 23 and 24 is one, market rents are potentially could have impact. So we've seen market rents increase basically essentially across the board. Apartments, multifamily, industrial, office and retail have been fluctuating. However, when retail and office buildings rents will typically soften because business expansion slows. So when people are not taking as much space, their businesses are not doing so well, and they start to not renew. This is going to make the vacancies for office retail increase, and it's going to impact the market rents because landlords are going to need to get these filled. So they're going to be asking for less rent per foot than they would be for if it was a tight market. Another thing to consider is the price of gas. With over $6 a gallon impacting, how's that going to impact commercial real estate? So what we saw with COVID, we saw a lot of people moving out of urban infills and moving to the suburbs. And now that they're working from home, maybe they're now starting to get back to work, and now they're having to make that long drive. What's that going to do? Is there going to still be demand for, say, Inland Empire area that took a big expansion, or are people going to start moving back to their office space environment, and that demand is going to decrease? We don't know yet, but it's one of those things to have an interesting conversation about and to watch. Also, the increase of cost of goods and increase of wages will drive up operating costs. So in my own business and everyone else, we've had to increase salaries. What that means is our margins are getting tighter. And so the one thing that business owners can try to do is, one, lower the property taxes or the CAM expense, but more importantly, they're going to try to lower their rental rates. So this is going to be one of those things to where tenants are definitely going to be trying to negotiate even more. We've got a deck here I want to show you. We did some analysis here of an apartment building that's just 60 units. And I used the same market rent comparison and using the same vacancy and expenses. However, what I did was change the cap rate from a 3.5 to a 4.5. And we did make a 10% increase in rents. But what we noticed here is that the difference in value from, let's say you bought this apartment building in, say, 2021 at a 3.5 cap, that value would be worth $19.6 million. However, let's say that because of the interest rates, the market cap rates changed to 4.5 cap, and we prove this with market data, then your value would have decreased to $17.8 million, or roughly $1.8 million reduction, which would save you approximately $22,000 in property tax. We're anticipating these kind of reductions in years 23 and 24 when the cap rates go up. The next example is looking at a triple net or an industrial value or a commercial property that's single tenant triple net. So on the side of the left, you'll see a $2 market rent using the same square footage of building, same market expense. However, we used a 4% capitalization rate. This would give you a value of $28.2 million. However, due to the increase in interest rates, the capitalization rates change. Let's say it goes up to 5.5. Using the same assessments, that value would have decreased to $20.5 million. That's roughly an $8 million reduction in value just based on 1.5% cap rate difference. We looked at what the rents would have to do to offset this cap rate difference. The rents would have to increase from $2 to $2.75 in that same period of time. And we just don't see that increase in rental rates in that short period of time. And so thus, you're going to be negative deleverage. Now, for property owners who've got really good steady tenants and you've got a locked in low interest rate, you guys from a cash flow standpoint are going to be fine. Yes, you're going to have the impacts of inflation. However, you're still able and you're still eligible for a property tax reduction just by making the cap rate argument. For property tax appeals, we look at fee simple unencumbered, meaning what is the market rent as of that date? What is the capitalization rate as of that date? So even if you have a rent that is paying you really great money and everything is fine and it's safe investment, you're still eligible and the tenant's still eligible for a property tax reduction. Another thing to consider with inflation is long-term leases that are disproportionately impacted. And what do I mean by that is I have a lot of clients that are in single tenant long-term leases, say a triple net or a grocery store, and those rents only increase maybe 2-3% a year when inflation's at 8% a year. As you can see here, those rent increases really don't offset inflation. And what we anticipate is for these types of properties that the capitalization rates are going to go up so that the new market investors can absorb this lack of increase in rents to hedge inflation. We anticipate this happening and being impacted on these as well. And again, if you have a property and you would like to discuss with us on how we can lower your property taxes, even if you're getting really great rents and the market's doing well, again, it's free review. You can give us a call here at 858-225-1200. Thank you for your time and attention, and we look forward to helping you save money by lowering your property taxes.